Hi, everybody, and welcome to today's webinar. I'm Leslie with the New Mexico Small Business Development Center, and I'm here with Tommy Thompson. He's going to be presenting the information to you, and we were chatting in the background about his history with this topic, and I tell you what, you're going to be in for a big treat, lots of information. There is some handouts. I'm going to chat over some links, so don't worry about picking them up right now, but you'll have those available for when you go back to your small business and learn this information, and then you'll have some handouts available. If you have any questions, please type it in the Q&A. We'll either pick them up throughout the webinar, or we'll definitely have time at the end for any of the questions that you have on cash is king, cash management for your small business. Tommy?
Thank you very much, Leslie, and good morning, everyone. As she said, I'm Tommy Thompson. I'm a SCORE certified small business mentor. I've lived in the Albuquerque, New Mexico area for about 10 years. My background is in professional accounting. I get to put the letters CPA after my name. In my case, they mean can't possibly add, but I've successfully hidden that from the professional regulators for almost 40 years. My background is largely in corporate financial management, troubleshooting, problem solving, business valuation, and financial analysis. We have about 35 or 40 years experience doing that in a number of settings, including venture funded business startups, which is always a fun and challenging way to make a living. A little guidance on the presentation. Your audio is already muted when you signed in. Please make sure you set your Zoom ratio to fit window. You can, up there at the top of your screen, there should be a little box where you can do that. That will help you better see the slides that we're going to work through this morning. We'll be using the Q&A function to take questions. As Leslie said, please write down your question in the Q&A box and add the slide number that relates to that question, if you would. That'll make it easier for us to get back there and address it specifically. We're going to do several things today. We're going to talk a little bit about the SBDC's training offerings and counseling assistance. We're going to talk about today's training objectives. We're going to talk about cash flow management and record keeping. That's our main topic this morning. We're going to take your questions on that topic and see where they lead. And then we're going to talk about some next steps, things that you can do with your business to start putting today's information directly to work for you. And that's important because while it's fresh in your mind, if you start doing the things we're going to talk about this morning, you'll find it much easier to recall them and much easier to make them effective for your business. Now, training offering and counseling assistance is offered through the New Mexico Small Business Development Centers. Their website is at nmsbdc.org. You can go there to find other training offerings for cybersecurity, pandemic response, and a whole host of other things. You can also use that website to request no-cost business counseling and loan application assistance. So keep those in mind as additional resources for you after this program today. Now, today, what we're going to talk about is we're going to talk about cash flow. What is it? What makes it flow through your business? We're going to talk about some strategic principles to think about that help you manage cash flow. One of which is a principle that says you got to be able to understand what you think is going to happen before you can deal with what does happen. So we're going to talk about forecasting cash flow and then talk about practical tools that you can use to manage your cash flow coming in and manage it going out. Finally, we're going to talk a little bit about record keeping for pandemic relief, and that has to do with justifying to government auditors, organizational auditors. It might not be the federal government, it might be the state or the city, what you did with the money you got from them in a loan or a grant. And the nice part about that is that if you do justify that properly, some of these programs actually let you keep the money without repaying it. So a loan turns into a grant. That's particularly true with the payroll protection program that was established back at the start of the pandemic. So those are the things we're going to talk about today. And we want you to understand first that cash is king in your business. It is the lubricant that makes business flow because it bridges the gaps between when you committed to do something and when you paid for it. And by doing that, the cash is the operating fluid, if you will, of the business. It's the oil in the motor. And if you run out of cash, inevitably you will crash, because without that cash, everything grinds to a screeching halt. There's no more lubricant. There's no more fluid to keep the business engine running coolly and smoothly. So cash is really the king asset in your business. And it needs to be something that you're thinking about every minute of every day, or at least top of mind most of the time, because you need to make sure that your cash flow in is smooth and on time, and that your cash flow out is smooth and on time as well. Now, what is cash flow? I like Yogi Berra's definition, and they pay in cash, which is just as good as money. Yogi had a lot of those yogiisms, and that's the one that I pulled that I think is applicable here. In a more formal sense, cash flow is the net amount of cash and cash equivalents, that's stuff that acts like cash, that are transferred into and out of a business. A company's ability to create value for shareholders is fundamentally determined by its ability to generate positive cash flow over time, to maximize long-term free cash flow. What do I mean by free? This is cash that's not needed for anything else related to the business. It can go back to shareholders or stakeholders without affecting the operation of the business. And that cash flow is what determines the business's value. So if you're concerned about creating lasting value in your business, cash flow is what needs to be top of your mind. Now, first of all, what makes up cash flow? As you might guess, it's cash money coming in. And not only the things that relate to profitability, but everything else, that every other source that might bring cash to your business over a period of time. From a profitability standpoint, cash sales, yeah. Collections on accounts receivable, right? People paying off on their promise to pay you. Deposits against future performance or prepayments for services or goods to be delivered in the future. All that relates to your profitability statement, right? But some things don't. For example, those pandemic relief loans and grants that have been coming around, the Payroll Protection Program, or PPP, the Economic Injury Disaster Loan Program, or EIDL, New Mexico state grants, shuttered venue operator grants, let me pronounce it properly. Those can all be cash coming into your business. They may or may not affect your profitability statement, but they are cash coming into the business. Also, bank loans that you get, loans you might make to the business. You whip out your checkbook and write a check and call it a loan to the business. Money that you get as investment or loan from family, friends, and fools, all right? Those don't affect your profitability statement, but they do affect your cash flow because it's cash coming to the business. Similarly, cash can go out for profitability reasons, or it can go out for reasons not related to profitability, but related to other obligations the business has. Compensation, your payroll every week or every other week going out, that's cash straight out the door. So are the benefits and taxes that are generated or withheld from compensation or owed by the business on account of employment. Also income taxes, those are cash flow out. Now, those may not go out at the same time your accountant recognizes them for book purposes. So we're going to talk about how you account for cash as opposed to profitability, or as opposed to accrual accounting, where we're trying to match the timing of expenses and income. Payments on accounts payable, your promises, your payoff on your promise to pay somebody tomorrow for goods received today. Rent to your landlord, the operating expenses it takes you to run the business, whatever those are, that's all cash money going out as it goes out the door, as the bank cashes the check. Similarly, bank loan repayments, capital equipment purchases, you're drawing money out of the business for your own personal support, money you pay back to family, friends, and fools. Those may not affect your profitability statement, but they are cash requirements, cash obligations of the business. So you can see that cash flow is different from profitability. There are more sources of cash and there are more uses of cash that go into a cash flow statement, that go into managing cash flow. Now, things that aren't cash flow include sales on credit. You give the goods today and Wimpy promises to pay you tomorrow for those goods he received today. The reference is an old Popeye cartoon where Wimpy says, I will happily pay you for a hamburger tomorrow, provided you give it to me today. Similarly, purchases on credit, your promise to a vendor to pay them sometime in the future for their shipment of goods to you today. Those promises are cash flow. Money isn't moving in or out of your bank account. So keep that in mind, that anything that doesn't move money in and out of your bank account, but does show up in your profitability statement, those are not cash flow. Those are accounting transactions that match income and expense, but not necessarily cash flow at the moment. So what's the basic strategy we want to use to manage cash flow? The first part of the strategy is you have to be willing to work at it. This takes some time out of your business week, and it will every week. Sometimes it will take time out of your business day every day for a while. But you have to keep cash in the top of your mind. Remember what I said, when you run out of cash, you crash. So working at cash flow is very important to keeping it moving. Next, you need to have some kind of funny idea about when you think cash is going to come into your business and when it's going to go out, in order that you can communicate effectively. We're going to talk a lot about communication this morning and the importance of communication with all the stakeholders in your business, your customers, your vendors, your bank, your stakeholders, anybody who has a stake in your business. When it comes to cash flow, you need to be communicating with people. Communication requires information. You don't get information unless you analyze data and develop assumptions about what's expected to happen in the future. And that's why you have to forecast your cash flow. I tell all my clients, you want to forecast your cash flow for at least 12 months in advance. And every month you want to update that cash flow forecast for the 12th month following. All right. And the reason for doing that is because you can then use that forecast to look down the road and to get a funny idea about when cash is coming in and when cash is going out. And when you see a need or you see a situation developing, you can then communicate with your stakeholders and take advantage of that situation. Whether that's to pay back debt early or whether that's to go get debt, cash coming into the business, or to apply for a pandemic grant or relief program. All right. You need to have a forecast of your cash flow so you can see when these things are coming, so you can get started on meeting that challenge or that opportunity well in advance. Third, you have to track cash flow. Every modern accounting system will allow you to produce not only a profitability statement and a balance sheet, it will also allow you to produce a cash flow statement. And you want to track that cash flow statement against your cash flow forecast. Because if you do that, you will then understand why your actual cash flow was different from what your forecast was. You can use the reasons for that difference to refine your cash flow forecast going forward, so that you can change an assumption here and there and change your forecast to match up with what's actually happening in the real world. Okay. Now, once you forecast it and once you're tracking against it, now how do you change it? How do you affect the speed with which cash comes in? And how do you affect the speed with which cash goes out? And the two principles in strategy that you want to work on here is you want to accelerate your cash in and you want to slow down your cash going out. Now notice I put a question mark before slow down cash out. Okay. And why did I do that? Because you might be asking, it's easy. You might be saying to yourself, look, it's easy for me to say that, but how do I deal with it personally? How do you deal with it personally when the time comes? And we're going to talk about some techniques to do that. All of them involve a certain amount of analysis and a certain amount of communication, talking to your customers, talking to your stakeholders. So you have to be willing to work at it. You have to forecast it. You have to track it. And then you have to work on tools that accelerate your cash coming in and slow down your cash going out. Sounds simple. We'll get into the tactics of it as we go along here. Now, the first thing I want to talk about is forecasting. And forecasting starts with a very simple premise. What's my cash position today? How much cash is in my business? Where is it? How much can I get my hands on? And if I aggregated it all together, how much is it? All right. The next question to ask yourself is, when do I expect cash to come into the business? Why do I expect it to come in? And when do I expect it to come in? All right. Against that, I'm going to measure or forecast. I'm going to make some assumptions about when cash goes out. What's going out? How much? Why is it going out? And when is it going out? And if I net the first three items together over a period of time, usually we use a month, I get an answer that says, what's my cash expected to be then, out there in the future sometime? Now, I'm going to make assumptions about what cash is coming in, why and from where. And I'm going to make assumptions about what cash is going out, why and when. So other than today, when I have my cash known today, everything else in a cash forecast is based on an assumption of how my business works. All right. And I'm going to use the actual results of tracking cash flow to refine those assumptions so that my cash flow forecast gets better over time. That's the whole point of this. You want your forecasting to reflect your actual experience as much as possible, absent life-changing, world-changing, totally unforeseen actions, events. All right. And we'll talk about how to deal with those a little later in the program as well. Now, I'm indebted to an author named Philip Campbell, who wrote a book called Never Run Out of Cash. For this example, he gave me permission to use it and to pass it on to you. I've only reproduced the first 6 months of the schedule here, but it's the basis for forecasting cash flow in your business. Now, it starts out looking pretty much like a profitability statement, right? Under section 1 there, we've got sales and other revenues. We've got a cost of goods sold. We've got a gross profit. We've got operating expenses and a total. But instead of coming down to net profit, we come down to a funny label called Ebitda. And Ebitda stands for earnings before interest, taxes, depreciation, and amortization. And that is used, that particular figure is used as a cash flow proxy by corporate financial analysts. And we're going to use it just because it's a little bit helpful here. All right. And that figure eliminates the effect of all of those 4 items, interest, taxes, depreciation, amortization, from our operating statement. It's a proxy for the cash money that our operations can be expected to generate. Now, not necessarily generate during the period of January. If we make sales on credit, some of this EBITDA is on credit and we aren't going to count it for cash flow. And you'll see in a minute how we account for that. But right now, suffice it to say that we have 6 months here. We've laid out what we expect our business revenues and expenses to be for those 6 months. And we've gotten down to an EBIT number at the end of each month. There are 2 other sections to this that I want to bring up before I bring up the real important piece. These are important in their own right, but they don't reflect timing differences. In section 2, we talk about debt service. Now, this is principal and interest. So here's where we account for interest cost going out of the business in the form of cash. Many business loans are a level payment loan. In other words, you pay the same amount every month. Some part of it is principal, some part of it is interest, but it's all cash going out of the business. And that's all we're concerned about here. So we're just taking the payments that are required and we're scheduling them out over the 6-month period. It's $1,100 a month in this case. The next section, section 3, talks about investments of cash. And this is where we account for capital expenditures. Capital expenditures are those things that we buy that we expect are going to last more than a year. And they also are going to contribute piece by piece, piecemeal rather, to our productivity, our profitability. All right. Now, normally you account for that cost of capital expenditures by calculating depreciation. But depreciation is based on an expected life and what it cost you when it was put in service. So we're only concerned about what it costs to put something in service, the capital expenditure in the first place, right? Because that's the cash that moved and when it moved. So that's what we have in section 3 here. Now, section 4 brings it all together, because what we're doing in section 4 is we're accounting for those cash flow items we haven't accounted for earlier, principally taxes. And we're also accounting for the timing differences between when we incur an obligation, a liability, or when we realize revenue, and when we actually get the cash in hand. Now, the first line here is that we're going to add back to our Ebitda the cost of goods sold. Now, those were goods that were already in inventory. We had already paid for them in the past when they went out the door. We're going to deduct instead what we paid in cash to buy inventory during the period. All right. And that's the cash that moved out the door. Now, in a more complicated business where we're manufacturing, those deductions could not only be raw material purchases, but also direct labor and factory overhead that actually was paid for in cash during the period. Now, up at the top line, we're going to deduct those sales on the assumption that most of them were made on credit. And we're going to add back, instead of that, we're going to add the cash we collected from direct sales over the counter and payments on accounts receivable. People who bought things 1 and 2 and 3 months ago who are now just now getting around to sending us the cash. So that item goes in place, goes into the calculation here. Now, tax payments generally don't have to be made at the time you accrue the liability for the tax. All right. You might accrue payroll tax liabilities, but you only pay them every quarter. You might accrue an income tax liability, but you only pay it usually on a quarterly basis. So here, the next line is estimated tax payments. In this case, $3,000 in January and $2,500 in April. When the cash actually moves is when we record that cash out expenditure. Now, the next line is a bit odd, and this is the change in accounts payable. When we get goods or services on credit from somebody, we don't have to pay them right that day. We build up an accounts payable balance with them and our vendor group as a whole. Now, at the end of the month, we look at that balance and compare it to the balance for the previous month. If the balance went down, that means we paid more credit costs than we got given to us. All right. So if we, for example, in January here, accounts payable went down $500, that means we paid it down in cash. Similarly, out there in March, it went up $750. And that means that we promised people $750 more than we actually paid them for that month, and the accounts payable balance went up. And that's a source of cash to the business because we got goods in the door that we can then turn around and sell, right? The 2 other lines are there for you to fill in with whatever your own accountant, bookkeeper, yourself decide is necessary to properly account for timing differences between when a sale was made and when it was paid for, or when you bought goods and when you paid for them. All right. Now, that comes down to a total of section 4. We net our Ebitda from section 1, our totals from section 2 and section 3, and our total from section 4 right here. And when we net those together, we get a number. And that number is labeled net cash flow. That's the net cash that came into or went out of the business during the month. We take that number and we add it to our opening cash balance. In this case, our opening cash balance was $10,000. You see where I'm circling the cursor right up here. And we take the 10,000 plus the $905. And at the end of the month, lo and behold, simple math, we've got $10,905 in the bank. Now that $10,905 becomes February's opening cash. We work through February and we find our $4,700 of cash generated, and we have $15,605 in the bank at the end of February. That becomes March's opening cash flow, and the whole thing just keeps flowing like that, month to month to month, all the way through month 12, whatever month that is for you. And I tell people, keep this going on a 12-month rolling forward basis, because that way you're always looking out across a 12-month landscape and you can see things developing. And therefore, you have the information you need to communicate effectively with your stakeholders to help deal with the situations that are arising, take advantage of the opportunities, guard against the challenges. All right. Now, there's two more lines on here that are worth talking about. And the first of them is the minimum cash balance target. Companies set minimum cash balances to help them manage their daily operations so they don't run short of cash in any random day. And they might set that based on a week's worth of normal cash expenditures. They might set it based on a month's worth. They might set it based on whatever number they like to use. I know one organization that believes that it needs to keep a year's worth of revenue as a minimum cash balance. That way, if they don't get any money, they'll have enough money to operate for a year. Now, that's extremely conservative, but that's what they do. In this case, this business has decided that their monthly minimum cash balance target is $8,000. That's what we need as a base number. Now, that might be partly to satisfy the conditions of a bank loan, which says you have to keep a bank minimum balance, right? So those are some of the ways that people set those numbers. But what it allows us to do is to subtract that minimum cash balance from what our real cash balance is and come up with a cash excess or shortfall number. If that number is negative on that bottom line, that's a shortfall. If it's positive, it's an excess. And we have opportunities to do with excess cash, and we have the ability to then start working on how do we fill that cash shortfall before it gets to us. We might forecast we have a shortfall expected all the way out here in June or even December. Now, if we're in January, we have 6 months to figure out how to fill that cash flow. It's not a case of coming to work some morning and all of a sudden, oh my God, we're $10,000 short today, and not understanding that that was going to happen. So forecasting becomes your chief tool and your extremely valuable tool in order to help you forecast your cash flow. In order to help you manage your cash flow, not forecast, that's what we just did. We're going to use these figures to help us decide, do we have enough money to take the risk to make a new capital investment, to expand our capacity, to keep our capacity at the present level, to replace old and worn out equipment that improves our product quality, all right, our customer service experience quality. So those are the things that we need to be talking about doing when we're forecasting cash. And in this case, we don't have a cash shortfall, but if we did, we have a couple, 3 months to talk to our banker to set up a quick coverage for that cash shortfall, and then pay it back in subsequent months when we forecast we're going to have excess cash again. All right. So that's what we're doing. That's what we're doing when we forecast. We're taking a look into the future. We're making assumptions about what the future is going to be, and we're writing that all down. So now we have a picture of what we think could be happening in our business going forward. That's information that gives us a better communication with our stakeholders. After you forecast cash, you track it. All the major accounting software that's on computers out there lets you create a P&L statement, your profitability statement, create a balance sheet, your statement of financial position. And it'll also let you create a cash flow statement. Here's how much cash actually came and went through the business. I tell my clients, if you're creating a cash flow forecast by month, you should be tracking it by month. If you're creating a cash flow forecast by quarter, you should be tracking it by quarter. In an emergency, when things are getting really tight really quickly, or events are moving very swiftly, you might be wanting to track it by the week or even by the day. I worked for a company in the 80s called the Troy-Bilt Rototiller Company. They made a garden tool that helped people garden better. And we would track cash flow every day. Every day we would track how much money was in the bank. And we would track how many orders were coming in. The marketing people, because back in the 80s, this was when direct marketing meant direct marketing through the mail, they could tell from experience how many orders they expected from any particular mailing dropped at any particular day. And they knew beginning a few days later what the pattern of those orders should look like and how many of them there should be. So we in the accounting department, financial department, issued a flash report every day. And this was a flash report. This is how many orders we got. This is how many we expected. This is the money we have in the bank. All right. Because in our case, our cash flow was very cyclical. From late February to the end of May, cash flooded in the business as people ordered rototillers, and they would send their money in with the order. In November and December and January and February, when people weren't gardening, people weren't thinking about rototillers and people weren't ordering rototillers. So we had far, far smaller revenue cash inflows. And we had to keep an eye on that big number we created back in the spring to make sure it would carry us through the year. And we did it by tracking. And we tracked it religiously every day, every week, every month, and every quarter. And that's how we could tell whether or not we were going to have sufficient cash flow to satisfy our investors, our investor owners, and to satisfy some needs of the business. For example, after paying bonuses at Christmas, people come to expect them. So how much of a Christmas bonus will there be? And we could make that determination in conjunction with top management based on our cash flow forecast and our actual tracking against that forecast. So that's what you need to do. Forecast it and track it. You get information from that lets you talk to your stakeholders. Now, what do we do to make it come in faster? Okay, when we need cash to come in faster, your first and best tool is to sell, sell, sell. Crank up your sales operation, by first analyzing your existing customers and what they've bought. And then call them up. Don't wait for them to call you, call them up proactively to offer more stuff, more of what they've been buying, or related products that make their product more attractive to their customers. And the way this accelerates cash flow in is that you offer pricing discounts specifically for fast payment, or even bigger discounts for cash with the order. Now, most accounts receivable policies have terms like 2% for 10-day payment, net 30. So you offer them 2% off if they pay faster. Well, this is a little beyond that. This says, I might offer you a 5% discount if you give me cash with your order, right? How much of a discount you offer is up to you and your business and your business model structure. But generally offering a customer a better price for faster payment for the goods that they're ordering is one of the things that you can use to get faster availability. Also, you want to make sure, though, that you continue your marketing and prospecting. Sales is moving product to existing customers. Marketing is about getting new customers, all right? And you want to make sure you continue marketing and prospecting for new customers at the same time that you're maximizing your efforts to sell to existing customers. I also advise clients to consolidate their business operating funds into one bank account. That will give you a couple of days faster availability. And in conjunction with another technique we're going to talk about in a couple of minutes, it gets you the opportunity to have your cash in the bank faster than you would otherwise. Now, also, when you see from your forecast that you're going to have a cash flow shortfall, start thinking about your alternative sources of cash. If you can borrow, if you have a relationship with a bank, you can go out and borrow, for example, to cover an increase in accounts receivable. Your customers are buying more, so accounts receivables going up. You need cash to support that increased receivable. You can borrow it from the bank under what's known as a revolving line of credit. That's matching the type of loan to what it's paying for. Your accounts receivable and accounts payable go up and down. A revolving line of credit can be paid down and brought back up, drawn up and paid down very easily without any big hassle. If it turns out that you need to borrow to make a capital expenditure, well, then maybe you might want a level payment loan over a period of years to pay off that capital expenditure. So you want to match the type of the loan to what it's paying for. Now, you can work on collecting your receivables faster, regardless of your collection policy, regardless of your accounts receivable credit policy. Your collection policy can be tweaked here and there so that people are incented to pay you more quickly. By using professional credit and collection techniques, you can communicate with your customers. You need to analyze them and analyze their payment record. All right. If on average they take a very long time to pay you, that's not a good thing. You might target those customers by either tightening their credit requirement, reducing their open to buy line, for example, which forces them to write you a check more often. Some customers pay you so slowly that it really isn't worth doing business with them on credit. So those customers, you might say, I'm sorry, I can't do business with you on credit anymore. I will take a credit card payment with your order or cash with your order. All right. And that gets you paid with the order right up front. Now, you have to carefully analyze your customers. How good a customer are they? How have they been? Have they had a better payment record in the past than they do right now? Are they important to your business in other ways? All right. They might be your biggest customer, right? And it might be 50% of what you sell. Those cases, you want to be sensitive and very, very tiptoe polite about attempting to change credit requirements or to get them to pay up more quickly. Now, when I say professional collection techniques, these generally involve a professional call and a follow-up on a frequent basis, okay, every month, for example. And it involves not just calling up to say, are you going to pay us on time? It means calling up and finding out a little bit about their business, building a relationship with whoever your counterpart is at that customer to understand their business, understand how it's going, to assess and offer them, different deals, and also to get a sense of, are they going to pay you on time? That's part of the conversation, but it's not all the conversation. And in line with that, as you do that, you want to be sensitive and you want to be building a relationship where the customer thinks of you first when they're making choices as to who to pay. Okay, that's the key. You want the customer to have your account, your business in top of mind when they start making out who they're going to pay this week. All right. And that's what this kind of professional conversation does, is it helps build that relationship and keep you top of mind in your customer's mind. Now, we talked about a revolving line of credit. We talked about a term loan. There's a third method of borrowing that's worth mentioning, and it's only generally used in a few industries in the US anymore. Chief among them are the fashion industry, and that's called factoring. In factoring, a third party buys your invoice to your customer, and the customer pays them directly. Now, when they do that, they're not expecting to get paid for a while. In the fashion business, you might ship everything to the customer in June and July and early August for September, October, and November sales. Well, if it's going to take you 6 months to get paid, maybe you need cash sooner than that, and a factor is that kind of outlet. They buy the invoice from you at a discount that represents their cost of money and their profit margin. And then they take the money directly from the customer to pay that invoice off. And everybody in the fashion industry, everybody understands this. And you tell your customer, when you pay this invoice, send the check to these guys, right? Finally, I tell people to use a lockbox service. Lockboxes are where your customers are instructed to send their payment directly to a post office box. That post office box is collected by the bank, and the bank collects it and processes it the same night. And by doing that, what you do is you get availability of cash in your account several days faster than if the customer sent you the check, you processed it through your accounting department and then paid it. And that might be a day or two or three later than when it actually showed up in the mail. And that's the value of a lockbox service, because it shortens the float by 2 or 3 days usually. All right. Now, this may not seem like much when your monthly cash flow is $1,000, but when your monthly cash flow is $100 million, this adds up to real money in terms of cash availability to help keep your business running smoothly. Now, on the other side of the balance sheet, what do we do to decelerate cash flowing out? The first thing we can do after we do some analysis is we can look at slowing our accounts payable payments, paying vendors so that they receive our check on the last day of a normal payment period. All right. Now, you can determine whether that's enough to be the discount taking date or whether it's the net 30 date. But you want to make sure that your payable system is set up to generate the check at the last possible agreed upon payment time. Now, beyond that, you can analyze your vendor list very carefully. It's separated into your A's, your A vendors. Those are people you have to keep happy. You have to keep them shipping to you. You have to keep paying them according to their terms. All right. And that's your A group of vendors. There's a B group of vendors. These are people you deal with less often that perhaps don't supply you with mission critical or customer critical items. They are folks that you could stretch out a little bit without getting too much pushback from them. And then there's a C group of vendors where, yes, they give you credit. Yes, you're taking the credit, but you can perhaps push them a little further along, depending on what you know about how they manage their receivables. Okay. In all these cases, you need to communicate with the vendor to tell your story, to ask them, would it be okay if I did this for a while, or ever, or whatever, right? And to tell your story, you need information. And that information comes from where? It comes from your forecast, and it comes from your tracking, right? You have to tell the story. No vendor wants to see a customer skip a payment without understanding anything or without any contact from the customer. All right. In the normal course of business, customers expect to make their payments on time. Vendors expect to get paid on time. When that is disrupted without any communication, immediately, in most cases, your vendor is going to be very concerned about you and your business viability. But if you've communicated with them, if you've had a chance to tell your story about what's going on, then they say, oh yeah, we had that conversation, we agreed to that, that's fine. And you continue on. Business flows smoothly that way. It flows less smoothly if your vendor suddenly says, oh, they missed a payment, I'm not going to ship them again. Oops, what happened there? Because you didn't communicate, your business got disrupted. So keep in mind that all of this all these techniques require communication with your vendors and stakeholders. Now, another way to decelerate cash flow out is to cut expenses. Yeah, right. That's easy for me to say. I need to analyze my payment ledger carefully, analyze my payroll carefully, analyze my outsourcing opportunities carefully, and I have to make some tough decisions about what I can just do without. But as you make those decisions, remember, don't eliminate marketing. Don't eliminate marketing, because if you disappear from the marketplace, your prospective customers don't know about you. Your existing customers wonder what happened to you. And your competitors all call up your existing customers and say, oh, so-and-so, we don't see him in the marketplace anymore. I wonder if he's out of business. And you don't want your customers thinking, what if he's out of business? So be very careful about that. Okay. Now, in an emergency, all bets are off. But again, the key is communication. Decelerate your cash flow out first. Go into specific negotiations with your vendors. Go into specific negotiations with your landlord. The whole point of those negotiations is to get their agreement that you can delay a payment and catch up later. In the case of vendors, can you delay payments and stretch your payment period from 30 days to 60 or 75 or even 90 temporarily, and bring it back within terms at some point in the future? With your landlord, can you maybe forego paying the full rent for a period of 1, 2, 3, 4, 5 months, and then catch up over the balance of the lease? Okay, by increasing the rent for the balance of the lease to catch up. In the same way you negotiate with your bank. Can the bank give you a delay in payment by saying you can skip payment for 3 months and then we'll pick up those 3 months either all at once, depending on what your cash flow forecast says, or ratably over the balance of the loan, or ratably over a period of months in the case of a revolving credit? All right. The next thing you do in an emergency is try to accelerate your cash flow in as much as possible. Call your customers, offer them a prepaid service contract. The deal being, pay us now, we'll give you 2 extra months out at the end. Prepaid subscription, same thing. Get 14 months for the price of 12, pay now. Gift cards are popular in retail and popular in restaurants, okay? Pay now. I'll give you a gift card. You can use it in the future, all right? For those of you who do business on contract with large organizations, look to try and include an advance contract payment in any new contracts. And that's legitimate because you may have some preparatory costs to get into a contract. And everybody understands that maybe you need an advance cash flow to work off future payments against for that purpose. Look into disaster and relief loans, the payroll protection program, the economic injury disaster loan program, the shuttered venue operators grant program, the New Mexico assistance grants, the city of Albuquerque assistance grant programs. Look into all those. Use your cash flow forecast to see the challenge coming so that you have all those applications in before you need the cash. And that way, when things happen, like the entire world shuts down because of a pandemic, that way you have already acted, you've been proactive. And this has the added advantage that your vendors, your customers, your other stakeholders all think well of you because you've been actively managing your cash flow, and you've actively been in communication with them. And they can say, hey, this guy's on top of his business. He knows what's coming in. He knows what's going out. He knows what he needs to do. He's acting like a rational, good businessman. Okay. Those are all things that help cement your reputation as a good businessman, is talking to people well in advance of need about challenges and opportunities, and then pursuing those as you promised to do. Now, what do you have to do when you get some of those pandemic relief programs? You've got to do record keeping and you've got to do bookkeeping. Your basic bookkeeping has to stay up to date. You can't track a forecast unless your tracking is up to date. All right. There are a lot of relief programs out there, federal, state, city. Each of them has its own specific requirements. Now, what they want you to do is they want you to keep records that can tell them what money came in, what was it for? What was this grant for? What was this loan for? What do you get to spend that money on? Did you spend that money on what you were supposed to spend it on? right? To do that in your accounting system, you might want to consider establishing sub accounts for each loan or each grant, both the incoming cash and when you spend that money, a sub account in your expense ledger that says I spent this grant money on this part of my publishing advertising. I spent this grant money on this part of my payroll, all right? Because at some point in the future, somebody's going to come along from one of those organizations and say, show me where the money, where you got the money, show me when it came in, show me what you spent it on, show me that you spent it in accordance with what it was supposed to be spent on. All right, be prepared to be audited. And by staying up to date with your record keeping and your bookkeeping, and record keeping is different from bookkeeping, you are then prepared, and it's a routine thing when the auditor shows up. Now, what do I mean by bookkeeping and record keeping being different things? Beyond bookkeeping, you need to keep the underlying documents of original entry. These are the things that gave rise to the entry in the books in the first place. And these can be payroll records, they can be leases, utility bills, they could be invoices from vendors. The whole point is that you need evidence, paper evidence. And yes, the world still runs on paper. Paper evidence of a payment and a receipt for that payment as to what it was for and why it was paid. And by doing that, you make it much easier for auditors to get through your books, and which makes it much easier for you because you spend less time on them. And that's time away from serving your customers. All right. Auditing and responding to auditor requests is a totally unproductive activity as far as your business life is concerned. And you want to get back to the profitable part of your business life as soon as you can. So to do that, the best way to do that, I've found, work with your CPA and your bookkeeper. If you have one or the other, work with them and make sure that as you take advantage of these different pandemic programs that are going to be audited, make sure that your bookkeeper or your CPA has set up your accounting system and your record keeping system to properly file all this stuff, so that you just have to go to the file, pull it out, say, here it is. And that gets them out of your hair faster. Now, there's a batch of resources on this slide that I'm going to go into in detail. More things for you to look at from a variety of places. I will mention Philip Campbell's book again, neverrunoutofcash.com. The forecasting schedule that we used here today came from there, and there's a live copy of it on his website, neverrunoutofcash.com. Both of those go into more detail about taking control of your cash flow. Also, there are some COVID-19 business resources in New Mexico that have to do with how to prepare and how to respond and how to run your business in a pandemic environment and do it safely so that as few people as possible actually get the disease and are harmed by it, or they have the potential to be harmed by it. Now, as far as SBDC goes, I mentioned their website, nsbdc.org. You can email them, info@nmsbdc.org, or you can call them on either of those two numbers there. You can also call the U.S. Business Administration. The site is sba.gov. The phone numbers that are there, the email that's there, will get you to their disaster customer service group, and they are dealing with pandemic as part of their disaster portfolio. You may have some trouble getting through. Call volume has been high, email volume has been high. They haven't had as many people as they should have had answering phones and responding to email and stuff like that. So keep that in mind as you go along. Now, again, I'll acknowledge Philip Campbell. I'll also acknowledge the National Federation for Independent Business, which contributed some material from its online archive to this program. Inc. magazine has another large online archive of useful business articles. And then SBDC's partner organization, of which I'm a member, that's the Albuquerque chapter of the SCORE Association, which is the nation's largest volunteer organization providing small business counseling assistance and mentoring. Now, I talked a lot. I talked for a long time. Some of this should have given you some funny idea about what questions you have. I'll wait a minute while you jot down any that might not have made it to the paper yet, and we'll be happy to take those questions in turn. Leslie will point them out to me as we go along.
Yes, sir. I also want to remind everyone that we are lucky enough to have Tommy Thompson for the next couple of weeks. So if you feel like you just got a handle on what's going on and you think of questions, we're going to be sending you the follow-up email that'll have the slides. Come back to one of the other sessions and ask your questions at that time, because we can definitely pick them up. I also want to remind everyone that some of the upcoming webinars that we have is we have Vic Bernaclaw. He is going to be talking about implementing your business plan. He has a 2-part series where part 1 is how to research and develop your business plan, and part 2 is putting it into practice, which is great. Also, we have Dr. Marvin Lozano doing accessing financial resources, and he's going to be presenting that bilingually. We have Eric Spellman, be the star of your YouTube and online videos. And we finish up the week with Peggy McDonough, who's going to be talking about, are you tax ready? Tax implications as far as PPP, EIDL, and employee retention tax credits. So if you need any help getting into any of the upcoming webinars, just email me and I'll be glad to help you.
And are there any questions?
There is not any questions right now.
Now, I'm not that good, folks, so I'm sure there's some questions somewhere. Please write them down and get them to us, or alternatively, bring your questions to the next presentation of this program, which will be next Tuesday at 9 o'clock. And if you sign up for it, register for it, you'll also get a link to it so you can join in. So we look forward to seeing you there. If there aren't any questions, then I want to say thank you very much for, well, when the thing starts working. I want to say thank you very much for your time and attention this morning. I appreciate it. There's a couple of things as to what's next. First of all, I want all of you to take the information you learned this morning, go back to your business and start building your cash flow forecast now. The sooner you start building it, the sooner you can start using it. The sooner you start building it, the sooner you can start tracking against it and find out if those assumptions you made were really good or whether they need to be refined a little bit. There's no time like now to start. So keep that in mind. There's no time like now to start practicing what we've been talking about this morning. Now, a little bit again, go to nmsbdc.org for other training opportunities, business counseling, loan application assistance. They also have a bunch of useful links to a variety of other resources. Also, please fill out and return the survey that you will get via email after this presentation. That survey helps me improve this presentation, improve the program and slides. And if you would just give it a good thought, prepare it when it comes to your email and return it to us, I will thank you a great deal for that. If there aren't any other questions or nobody's got issues they want to raise, I want to thank you very much. This is the bibba at the end, folks. Enjoy your day and go forth and manage your cash better.
Thank you as all, Tommy. We appreciate the information and you guys have a great rest of your week. We'll see you next time. Bye.